Good morning. This is Anthony Parent of IRS Medic, and today is June 27th, 2023. And we have a few topics for you today. We have number one, the Moore transition tax is headed to the Supreme Court. We'll get into that. And then we're going to talk about inflation. There was a great article in the Wall Street Journal about how the IRS sort of owed these benefits from money printing, and particularly the net investment income tax. And then lastly, we're going to tackle a foreign inheritance and renunciation tax issue. But so let's get right into the Moore. And I figured this was a good place to start off because this would get us all properly enraged, because it's a quote from Senate Finance Chairman Ron Wyden of Oregon, who issued the following statement today on the announcement of the Supreme Court will hear Moore versus United States, a case dealing with the parameters of the congressional authority to levy taxes. This is what Senator Ron Wyden has said. And if you're a fan of this channel, you know we're not much of a fan of Ron Wyden. The petitioners and more are hoping the Supreme Court will toss out a Ninth Circuit ruling along with potentially decades of settled law and bipartisan agreement on congressional authority, all for the benefit of the ultra wealthy. If the Republicans on the Supreme Court take the petitioner's side, they'll be handing a massive windfall to the multinational corporations and could potentially lock in a right for billionaires to opt out of paying anything remotely close to a fair share in taxes. I designed my approach to taxing billionaires, the centerpiece of which is an accounting method already used in our tax code, with the understanding that special interests would come at it with well-funded legal challenges. I'm totally confident that it's constitutional. Oh, Ron Wyden, John Richardson, thank you for joining me today. Is your skin crawling at all today with the words of Ron Wyden, the lizard? I mean, I do think, remember that show in the 80s, V? It was about aliens and they dressed like humans, but the secret was that underneath that skin, they were aliens. That's what Ron Wyden reminds me of without the human skin. He is truly a obnoxious human being, as we'll get into. John, what do you say about this? What do you think? What do you think of Ron Wyden here?
You know, Anthony, there's no need to attack him personally. His ideas are sufficiently offensive. So let's just concentrate on his ideas. It's hard to even know where to begin with this. The first thing I would point out is that this is about this transition tax. It was part of the 2017 Tax Cuts and Jobs Act that at the time Senator Wyden was upset about.
Right.
Okay, interestingly, right?
Right.
And, now, of course, he's decided that he doesn't want it tampered with at all.
Right.
But here's the thing, okay? I think the discussion needs some context of what this actually is about. Many Americans abroad carry on business through small business entities that would be treated under the U.S. Internal Revenue Code as corporations. They're obviously foreign to the United States, therefore they're foreign corporations. And because most of these are owned pretty much outright by the U.S. citizen shareholder, they're controlled foreign corporations. As part of the 2017 Tax Cuts and Jobs Act, okay, a law was passed pursuant to which the U.S. Treasury effectively confiscated 15.5% of the retained earnings. So the first point I would make is that, and this is retained earnings over the period from 1986 to 2007. So the first point I would make, regardless of any of these other things that are discussed, is that it's very clear that this was a retroactive tax. There is no way that under U.S. law that these earnings were taxed to the shareholders at the time that they were actually earned by the corporation. So although there are some who take the position that this is not a tax on wealth, that it isn't a tax on income, it's just that the income is attributed to another person, the simple fact, or should I say fact of the matter is that it is a retroactive tax, no matter how you look at it, upside down, sideways, and diagonally. So at a bare minimum, leaving aside the rest of the content here, Senator Wyden is clearly advocating for retroactive taxation, okay, or the constitutionality of it. And that I think speaks for itself. Secondly, the Tax Cuts and Jobs Act was really well, was a trade-off, okay, that U.S. multinationals in exchange for reducing the corporate tax rate from 35 to 21%, were expected to pay a tax on the retained earnings that had not been distributed to the parent company and therefore not taxed in the United States. So this was completely about multinational corporations. But it had an incredible impact on small people who had corporations, foreign corporations, meaning outside the United States. And, I've worked with many of them over the years. And basically, a lot of them had to liquidate their companies to pay this. I mean, I remember the case of one doctor in British Columbia, worked his whole life. He was 65 in 2017. He had $2 or $3 million of retained earnings in his corporation. And by the way, in Canada, these small business corporations are really private pension plans. So let me just say that he had 2 to 3 million in his pension plan, his Canadian pension plan. And under the US rules, this transition tax came in and basically put him in a position where, get this, on retirement, he had to put a massive mortgage on his house in retirement to be able to pay this. So there is absolutely no question, when Senator Wyden tries to, paint this as something that has to do with the wealthy. No, absolutely, positively not. In fact, the vast majority of taxpayers, and this is absolutely indisputable, the vast majority numerically of U.S. taxpayers impacted by this transition tax were individuals, because all we have to do is look at the number of Americans abroad. So this was one of the single most destructive things ever coming from the United States in general and from the Democrats in particular. That is their support of this. Oh, this is Republican law. Okay. But, now he's adopting this sort of thing, right? It was, really the most egregious attack, I think, on Americans abroad ever. And, he uses the word bipartisan, and it was bipartisan. Okay, there's no question about it, because this was the result of, tax reform consideration over a lot of years through a number of administrations. This has nothing to do with billionaires at all.
Well, you're right, and I think that's a great time. Let's go to the actual Moore case and what it's about. Because as Ron Wyden is talking about billionaires around the world, it's actually, Charles and Kathleen Moore of Washington State, they were hit by a surprise $14,729 tax bill that they never seen a dime come from their income from a friend's company in rural India. They were taxed instead on the unrealized income of a foreign country. So the Moore sued for a refund, and the Ninth Circuit ruled that a realization of income is not a constitutional requirement, which would actually goes right against the holding of a Glenshaw Glass, which requires a realization event to occur. That is the test for income. So the Ninth Circuit sort of went around the well-established test for income, and the problem. And I think this is the biggest problem for this. If that realization is no longer required in order to tax someone's income, well, now if you've changed income to mean something that isn't income, therefore, I think the biggest fear that I would have if Moore is upheld is that if realization is not required, then any and all things will be considered income, or could be. Do you believe that? Do you believe that could be true, John?
I think that is true. There's a lot of interesting discussion about the case, though, and some people argue that, well, this was income realized, but income realized to a foreign corporation. Therefore, it was really attribution of realized income to the shareholder.
Oh, boy.
There is that argument. That may be that it's a distinction without a difference. But my point is this. I think that this can be decided on the basis of the retroactivity alone. A retroactive tax going back 30 years is so indescribably unjust.
Well, you know what? Let me, Keith, let me go over to Keith for this, because, what we always want in our law system is predictability and to know where you stand. But imagine this, the year is 2016 and you think, oh, I'm good with everything. I'm good with the IRS. Everything in life is good. What do I have to worry about? And then the next thing you know, there's a surprise tax. And well, if you knew that was coming, there would have been things you would have done. So Keith, you must have heard about people getting destroyed all over the place and by the surprise. I mean,
Yeah.
tell me a little bit what you hear, what people's reactions to this thing has been.
Well, I've spoken with people, as John has said that he has, and I'm sure you have as well, who are losing everything as a result of this retroactive transition tax.
Yeah, that's
Number one. Number two, I've also heard from people who do, who are Americans overseas with the small to medium-sized businesses, structured the way John was talking about, and they're actually very grateful. And you know why they're grateful? Because they never entered the U.S. tax system. They never entered it, and they're singing hallelujah, hallelujah. I made the right decision. And this is just another example of you got to really think through what you're going to do moving forward. So those are the two camps that I hear from on this particular issue.
Yeah, there's not a lot of kindness, and from people like Senator Ron Wyden, not a lot of incentive to join the system. I mean,
No.
he seems pretty, bloodthirsty for more and more. Government needs more and more.
Yeah.
I think the easiest way to describe the transition tax in a small bite would simply be this: it's a retroactive tax on fake income.
Well, I wish I was laughing.
Tell me how that's wrong.
I wish I wasn't laughing so hard, but yeah, that's it.
Yeah.
A retroactive tax on fake income. There you go. That's right.
And Wyden is defending this. Okay.
Right. Wyden is defending it because, and I mean, again, as you said, this was a Republican law. This was a Republican law signed into to law by President Trump. And to listen to Senator Wyden, it's like, well, you switched really quickly on this thing. Wow, all of a sudden, and I would always say that's a sort of a warning for Republicans or anyone. If like you pass something, understand it's going to be used against everybody.
I think when you look at this comment in totality, right, what he's really upset about is any impediment to the possible taxation of wealth. That's what he's really upset about. Okay.
Yep.
Now, and I think that regardless of your party affiliation, I think that, you really need to be concerned about this, right? You may hate the rich. I don't know. Apparently a lot of people do until they realize that they happen to be one of the rich as well. Okay. According to the Senator Wydens of the world. But I think you've got to be concerned because, what he's done is he's sort of gone into overdrive in complaining about anything that could possibly be construed as an impediment to the taxation of wealth.
Right.
Anything that could be construed as an impediment to simply characterizing anything at all as income. Okay. And by the way, I mean, let's look at we're there already. I mean, the 877A exit tax is deemed income, all right, very clearly. On a more pedestrian level, PFIC taxation is an interest charge on income that may not have been received in the year. Okay. So, make no mistake what this is really about. And I think that people need to take off their partisan blinders here a little bit and look at what's really going on. My view of this, well, obviously, my position is that the transition tax, okay, is a retroactive tax on fake income. I also think the whole Subpart F regime is really an in run around the standard tax treaty that prohibits one country from taxing the earnings of the corporations of another country, which it clearly is. But ultimately, the Supreme Court has an easy out here, I think, and that is just to say, we're not going to get into the issue of unrealized income. We don't have to, because the fact that this is a 30-year retroactive tax means that it's so offensive that regardless of what it is, it violates principles of due process.
Absolutely. All right. That is an awesome summary. So we hopefully will hear this case next term.
Yeah.
And
more to come.
Yeah, more to come. Now let's move on to this topic. There's a great article in the Wall Street Journal this week, just Monday, about inflation and its impacts and how it's been catching people by surprise with the uh, net investment income tax. Now, what is inflation? And this is a thing. I think there was a lot of as I was growing up. I remember this. Inflation was an unknown thing. No one knew how to do it. No one, growing up in the 70s and 80s, we don't know what causes inflation or how are we going to fight inflation. Well, it's all a distraction. Inflation isn't caused by high price. It's not caused by long gas lines. It's not caused by war. However, this is something that interesting. Secretary of War Edwin Stanton used paper currency to help destabilize the Confederate economy. He did it stealthily. He did it on the side because he didn't want the South to retaliate. And in the Civil War, the South was doomed, but this hyperinflation the U.S. government caused didn't really help. And so we know that printing money can be considered an act of war, and we certainly didn't want the Confederates doing it back to us. So what are we in now? And this is something the great Milton Friedman had this. Inflation is always and everywhere a monetary phenomenon in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. Okay, so inflation is caused by one thing: more money being printed, devaluing the value of the money the hard-earned money you already had and all of your assets. And this is sort of where my education on a lot of things happened. I was at a Tea Party assembly. I don't even know if that's what we call it, in 2009. And there was a Democrat there. And I was like, okay, hey, look, I'm an open guy. I got some, I want to hear what this guy has to say. And so he had a book out. It was the book, The Seven Deadly Innocent Frauds. I met him, talked to him. He said, yeah, everyone has it all wrong. I said, well, I'm a tax attorney. He goes, oh yeah, everyone has it all wrong. I go, what? He goes, well, the IRS, the IRS doesn't need the revenue to collect. The government doesn't need the revenue to collect. I said, well, how could that be? He goes, no. The IRS exists to destroy excess dollars so that hyperinflation doesn't create. The government always gets as much money as it always needs, and it will never be in any position where it won't have as much money as it wants. Now, what may happen is because of this dynamic, you may wind up with a hyperinflationary state. So what is used to correct this? Well, that's what the income taxes are used for. Now, in 2016, Rudy Giuliani was running for president. And one of the things that he had on his platform, he says, you know what we really should do? We really, people are paying these capital gains on things, but these capital gains are phony because, okay, so you sold your property, and you know what? You bought it in 1950 for $100,000, and now you sold it for $800,000. It's the same property. Nothing ever happened to it. You actually really didn't have a gain, but the inflation made it look like you have a gain. But now you have an inflated gain. So now you have to pay taxes on your inflated gain, even though it was the same property. Nothing happened to it. It was just the exchanges. And so the IRS actually gets it both ways. So the government gets it both ways. They get to steal your money through printing money, and then they get to tax you on their own theft. You're the one who gets the bag on your own theft. And so now as we get and this is one of the critical things, and I've learned to accept. And if anyone has anything to debate, I'm open to debate. This is a theory. I'm not entirely sure this is true because a lot of things are hidden from us. However, this theory, since I learned about it in 2009, there has not been one thing that surprises me about the government. It's like, yep, that's what I knew. The debt ceiling fights, they're always fake. Never go for them. Never believe it. The government will get everything they need. Things you need to understand, 1913 is that's when we have the Federal Reserve Act of 1913. They print the money, the real income tax of 1913. They go hand in hand, pass within weeks of each other to destroy the money. That is how it works. Now, states are different. States actually need the revenue. If you're not printing your own money, you actually need the revenue. But the federal government doesn't need any revenue whatsoever for its purposes. It just wants to avoid hyperinflation. So the question is inflation theft? The answer is absolutely. The lure of inflation is that the inflator can acquire real resources at virtually zero cost. So by government spending, the government can acquire things with no cost whatsoever. That is called theft. Now, let's move on to you make a lot of money tax as it hits more Americans. This is an article that was in Wall Street Journal, being got a lot of traction. This is by Laura Saunders. And with Obamacare, we had something called the net investment income tax. And that was supposed to fund Obamacare, which whatever happened to that, we're not entirely sure. But what was interesting back then is they decided not to adjust the $250,000 threshold to inflation. And because when they did that, now, and if you just look at this chart I have at the side here, you can see how this revenue they're getting is expanding, because this is all inflated money that is forcing people that makes people get to the net investment income tax. So now, I don't think there's much of debate about what's going on. So this is the question I have for both of you guys, for both of you. How does the net investment income tax affect expats and anyone investing outside the U.S.? Are they getting hit worse, better? Does it matter? John?
Yeah, I think that actually Americans abroad are probably the biggest victims of this. Okay, and you're absolutely right that inflation erodes the value, of assets. I would also note that it erodes the debt, right?
Yes.
I mean, you owe $1 million and you've got 10% inflation, you're paying back less every year. And, the US government has, I think, quite a bit of debt, right? However, let me give some examples, some very practical, down to earth, non theoretical examples to show how Americans abroad are damaged by inflation in the tax code. Okay. First of all, I want to give a shout out to Laura Saunders, Wall Street Journal, a tax reporter who really does fantastic stuff. And I met her a few times, and I think that it would be great to take her articles and put together a little book called The Best of Laura Saunders or something. It's really good stuff, and she has a gift for making the complicated understandable. Now, the net investment income tax, if we start there, was, intended to be a tax to, fund Medicare for Americans. Americans abroad, of course, have to pay for that, all right, even though they don't get the benefit of that. So the first point is that on the tax itself, that really it's a way to get Americans abroad to pay for health care for U.S. residents. Second point I would make on that, and this is very, very interesting, the way it's written into the tax code is that most Americans abroad understand in a general sense that to avoid double debt, to at least mitigate double taxation, they get a tax credit for foreign taxes paid. The way the net investment income tax is written is that it specifically does not allow the use of the foreign tax credit on income subject to the net investment income tax, right? So let's say that somebody in Canada sells a house, has a $500,000 capital gain that's taxable. They're going to pay the tax in Canada. They'll use that to offset tax in the U.S., but they cannot offset the net investment income tax, that 3.8%, using the foreign tax credit rule. So this is really a U.S. charge on investment income of Americans abroad. Okay, it also guarantees double taxation for Americans abroad. Now, on the issue of inflation directly, one, many Americans abroad are renouncing or considering renouncing U.S. citizenship. They're covered expatriates if their net worth is $2 million. Let me tell you, okay, that $2 million exemption is becoming very, very little. If you own a house where you've had a lot of inflation in the price of the house and a lot of inflation generally, so that's an area, 2 million, not indexed for inflation. FBAR, this is fascinating. I think a lot of people don't know about this. So on a general level, the $10,000 reporting threshold has been around since the 70s. We're now in 2023. And guess what? Because of inflation, more and more people are subject to FBAR penalties. They're subject to FBAR reporting and therefore FBAR penalties. But Congress understands inflation because they passed a law a few years ago. More people are subject to penalties, indexing FBAR penalties to inflation, right? So the U.S. is really using the FBAR thing both ways. We use inflation to get more people to penalize, and then we use inflation to increase the amount of the penalty that they have to pay, right? Another example, last week we talked about in the FATCA IGAs, the $50,000 exemption for the U.S. for the depository account. That's not indexed to inflation. Every year, all right, that's going to become more and more meaningless until that exemption to the definition of U.S. account goes away. Third, PFIC taxation. As you may know, there's a Treasury regulation that for a single filer would exempt $25,000 of PFICs. That's not indexed to inflation. Sooner or later, that's going to go away as well. But here's one that people don't even think about that affects them. So, as you know, there are many U.S. citizens outside the United States who are married, okay? And they are married to non-citizens in many cases. And as you know, the general procedure would be married filing separately. Few people want to bring their non-American spouse into the U.S. tax system. But let's look at the threshold to have to pay this Obamacare surtax, all right? Well, okay, it's $125,000 for married filing separately, but $250,000 if it's joint, okay? So not only are we getting more people generally through inflation into the net investment income tax system, but Americans abroad are particularly affected because more of them are likely to file married filing separately, meaning that the threshold for them is going to be lower.
Right. Because you have
there's an example on that. And in closing, I would recommend a fascinating book. It's an old book by David K. Johnston called Perfectly Legal, where he talks about the U.S. tax system. And, he talks about how how inflation caused the alternative minimum tax that was supposed to be for the rich to transition from a class tax, the rich, to a mass tax where more and more people were affected by it. It's a great book. I recommend it. It's called Perfectly Legal. And there are clear similarities between inflation and the net investment income tax, drawing more people into it, and the way this worked with the alternative minimum tax. But once again, to be clear, inflation has a much, much bigger impact on the U.S. taxation of Americans abroad for the reasons I've given than homeland Americans.
Wow. John, thank you for explaining that so clearly and precisely. That's amazing. We are incredibly fortunate to have you as a guest. I want to ask the same thing to Keith. Anything else, Keith? Anything you would say about this? Any stories of this affecting expats harder?
To be honest with you, it does affect them, but I think John outlined it very precisely. I think the only thing I can add is in that one area, because that's not my bailiwick, but that one area in financing Obamacare, as John explained, that you cannot use the foreign tax credit. It just is yet another example that there is double taxation of Americans overseas, because we consistently hear from homeland Americans that the treaties, the treaties are there for stopping any type of double taxation. False. It does occur. That's the only thing I can say at this point. But John outlined it thoroughly.
May I add something to what Keith is saying?
Absolutely.
You make a good point, Keith, in bringing up the treaties. But I really must say that this claim that the treaties prevent double taxation is generally completely false. Because the way the treaties are written is that, it's always subject to the laws of the individual country. Now, I do agree that, the treaties vary, and I do agree that there are certain treaties where this is a bit of a help. But it's not the treaties that prevent the double taxation. It's the internal laws of the two countries. And the way this is done in the U.S. is generally through, foreign tax credit rules and things like that, which clearly, don't apply in this case. I mean, look, the net investment income tax, for those who want to refute the argument that somehow there's no double taxation of Americans abroad, just point out the net investment income tax. It is a clear 3.8% charge on the investment income of Americans abroad. and they're subject to double taxation. Case closed. That's it. Okay.
Yeah.
And I think I just want to step back a second, because I think when first of all, I think if we think about it, nearly every American is subject to double taxation. That inflation is the way that we're stealthily taxed, and then we're taxed on the phony gains that inflation created. So that's sort of a double taxation of itself. So what I would say is that expats are triple taxed. So it's even one level worse. Like the U.S. being in the U.S. is terrible, and then whatever it is being expats one up. So everyone's getting treated horribly. Expats a little bit worse for sure. And kind of the indifference as they're going along, and no one. I don't recall anyone advocating for a change in this. So really, really watch out. And I mean, it's going out now. One thing I would say, this is, there's always usually some ways to work around things. And so this is, one of the big things is when you are going to sell something, that's really when you want to get some legal advice, because one simple way is to get an installment, get an installment sale. That way you're not getting a lump sum that you're taxed on a whole bunch, but rather a lower amount. So hopefully you kind of come underneath that threshold.
Yeah, that's right. You'd want to sell things gradually. One other thing that just came to mind that I should have mentioned, make no mistake that although this started out as a tax on investment income, in the Biden Green Book, okay, I mean, this is real. They proposed extending the net investment income tax to other forms of income, which include active business income, okay, partnerships, etc. So make no mistake about it, okay? This is a separate tax system that has been created. It's a separate tax, okay? Although it's in the intro, it's a separate tax. And they're going to expand this thing and expand it so that it becomes a 3.8% charge just on having any income. So in other words, we're going to have, the usual Internal Revenue Code. Then we're going to have a separate code that says, well, hey, you make any income, we want 3.8% of it over and above everything else.
There it is.
And look, again, this is real. Look at the Biden Green Book. The proposal is right there.
It is. And so it is just getting, wow. Let's
So
move
that's
on.
what.
Yeah, go ahead. Keith,
No, I'm just going to let one last quick point, and that's why I tell people they need to really take a hard look on: is it worth it to retain their U.S. citizenship?
Yep.
Is it worth it moving forward? They need to take a look at the future value of it. Point blank.
Absolutely.
You mean the future cost?
For future
Yeah,
costs.
future cost. Excuse me. Future cost of it.
If it's a pure, Keith, if it's a pure monetary decision, okay, let me be very clear here. There is no better financial investment in your future than renouncing U.S. citizenship. It is the only investment, even if you pay an exit tax, there is no investment I know of that will pay you a dividend every second of every minute of every day of every hour of every day of every week of every month of every year for the rest of your life. There's nothing that's remotely close if you look at it from a purely financial perspective.
Yeah,
that's right. Yeah, and that is absolutely right. One thing I wanted to add about this is back to Keith's point. Now I can't quite remember my train of thought, so hopefully that will come back to me about what I was just going to say. But we'll move on to the next topic. Hopefully is renunciation and inheritance, because this is what I wanted to say.
Yeah.
That if follow the chain of law that Warren Mosler, the chain of logic that Warren Mosler had. He says, look, the IRS exists to destroy excess dollars printed by the federal government. Okay. Well, if that's true, well, we know one thing: there's been more money printed in the last few years during COVID than ever before. There's more money out there ever before. So really, and I can think of one other way to destroy money, and maybe there's a few other ways, but the best way to destroy money is through high taxes. And so I think the thing is we have to realize the only real meaningful control to high inflation is higher taxes. So if you're not aware of that, if you're not aware of the war that's going to come to you to destroy your wealth so that so hyperinflation doesn't happen, you're going to be caught by surprise. And so this is where it is absolutely critical. I think, John, I think it's like, if you're thinking of renouncing, go through the cost. Maybe you can find a tax plan that will allow you to stay a U.S. person, or maybe you look at it, it's like, you know what, it's time for me to go because this is just going one way. That money has been printed. How is it going to be destroyed? It's still getting printed. How is it going to be destroyed? By the ever creeping of these things, and stealthily. Yeah, this is a perfect way to do it. So you got to protect yourself. If you want to stay a U.S. person and you have assets, you got to protect yourself. Or I would say this: don't have money in your life. That's the other way. Be rich other ways. I don't know. It's not through U.S. dollars, which we actually don't even own, because any dollars you own, they're all subject to how many someone else prints that you have no control over. So it's, how do you even own it? You can't even control the value of one of your dollars. You don't control it. So really, you want to think about, why do you want so much U.S. dollars? That's really, I would think, that just like, why do you want so much? If you're a U.S. person, you kind of need them because you got to pay your taxes with it. So that's a reason to renounce. It's like, look, I don't even want to deal with the U.S. dollar anymore because it's something that's totally unpredictable, and they'll change the value of it. It always goes one way. That might be a reason in itself to renounce. Which brings me to the question that you brought up, Keith. You want to tell me what this was about? You got it.
Well,
yeah.
yeah, you certainly outlined it in the slide. What's coming up is, I was talking a client, if you will, I think a couple of weeks ago, and her situation, we'll discuss it, is, she has inheritance that will probably come her way from Americans who live in different parts of the world, not in the United States. And her big question is it beneficial for her to renounce or not renounce based on what the rules are when it comes to inheritance? She's confused on it, on which way to proceed. So hence the reason why I wanted to bring up this case discussion for the two of you,
right?
Because she's in that quandary on what's going to be the best thing for her to do.
Okay. So we have a father, and so we don't know, we don't know the amount she's going to inherit, but let's assume that, we could just assume it's going to be by inflation.
Right. It's going to be a substantial amount.
Okay. So her father is a green card holder, so he is a U.S. person.
Mm-hmm.
He's living in Portugal, but he's still a U.S. person. So
right.
he's subject to the U.S. federal income tax, federal estate and gift tax, as is the mother.
And the mother's in Canada.
And the mother's in Canada. She's an American citizen.
Right.
So both the father and the mother, they're subject to the federal estate tax. And as citizens, and then her sisters are both Americans, and so really, they would be taking it. It would be, as it is now, they would be taking their inheritance subject to normal rules for every other American. The estate tax exemption would be about $12 million, somewhere around there. So anything below that, no tax due. As it goes above that, there would be a tax due.
Right. Now, let's say maybe I'm jumping the gun, Anthony. Let's say she renounces and she's no longer American. What will that look like for her?
And now she is still living in the UK.
The UK, correct.
Living in the UK. So as a non-US person taking a trust, I can't think of anything that would frustrate her from taking that if she renounced her citizenship. I don't see that there would be a tax due if she renounces.
Right. From the U.S. side of things.
Right. From the U.S. side.
The UK, that could be different.
Right. Yeah.
Right.
So you just got to make sure before, you jump on one thing, but you got to look at where you're jumping into. So that doesn't appear to be an issue if she renounces or not to me.
On the U.S. side of things.
On the U.S. side of things.
Right. Yeah, exactly.
John, do you agree?
I agree with you in terms of, the statement of, what the U.S. law would be on this. I mean, the U.S. does not tax gifts and inheritance in the hands of the recipient. But there is one thing that I think perhaps needs to be considered here. And that is that I have the impression that at the moment, if she's considering renouncing, that her net worth may be below $2 million.
That is correct.
It may be that, yeah, okay. So then she has a window period to renounce. Okay. If she inherits all this stuff and the way you're talking, she's going to be over 2 million, then she's going to become a covered expatriate, right? Which would complicate renunciation later. All right.
Right.
So, that's I think an important point. I mean, there are other odds and ends here. I think you always have to ask, what's the position of the country of residence?
Exactly.
The UK does not tax inheritances. Okay, so no particular problem there. Although the UK does have.
Well, let me ask. I'm interrupting for a second. Let me ask you something, because in France it's a little bit different. So the UK does not tax inheritance. Okay, does that mean whether she's American or not American? For both? Because France is a little bit different on that one. So that's why I bring up the question.
Well, the facts you're giving us that this person's a tax resident of the UK, right?
Correct.
Well, I'm not an expert on the UK situation by any means, but my understanding is that the UK does not tax inheritance in the hands of the recipient. They have what's called inheritance tax, but it's really analogous to the U.S. estate tax.
Okay.
That kicks in over, I think, $325,000 on that. She's likely to lose a good portion of it if she stays in the UK from, to the UK tax authorities, actually, when she dies, unless she, uses their own rules to get rid of the stuff, which is generally she's got to make gifts and live for 7 years after making the gifts, etc.
Mm-hmm.
I don't think her problems really are from the U.S. side here.
It's more investigating what it's going to look like from the UK side.
Well, I think she should advise her parents to make sure, if they really have this amount of assets, whatever, to make sure they remain U.S. persons when they die. Because if they renounce as covered expatriates, right? If they renounce as covered expatriates and then leave things to her, and she's the recipient of a covered gift, right, which is a 40% tax on the U.S. side. So, there's a lot of what you need is a family consultation.
Yeah.
Okay. And I think that the family consultation should consider family expatriation. Now, another point, Keith, that is completely unclear is what are the assets that she's inheriting? Okay, because remember,
I believe, if memory serves me correctly, it is property and money.
Is the property in the United States
and cash? Yes.
Well, this is a problem. Okay, this is a problem because so we look at this from the point of view.
I think it's in the United States. It's either there or in Portugal.
Remember that how the U.S. brutally taxes the estates of non-resident aliens, okay, who own U.S. cited assets. So, that's a question that they really need a family consultation.
Because what you don't want, and John's bringing up, and this is really important, is that if she inherits U.S. cited property as a non-U.S. person and she passes, that estate tax has an exemption of $60,000. If you're a U.S. person, it's 12 million. Couple. Around 12 million. So that estate tax passes at a incredibly low, and so it can be really, really punitive. And so the workaround to that is that you have a foreign entity own the U.S. asset.
Actually, Anthony, there's remember that the UK has the 40% inheritance tax, right? And in the U.S.-UK tax treaty, basically, I think the answer is she's able to credit the tax paid in the U.S. against the U.S. tax on the estate. I think that that this is another general consideration. Okay, what are the estate and gift tax treaties between countries? But look, if nothing else, I hope that this back and forth that we're having shows why it's absolutely essential to get competent help with all the facts, right? I mean, we don't even have all the assumptions here.
Right.
Sort
Well,
of-
exactly. And so when you say family consultation, John, you mean with a reputable tax attorney to sit down and talk about this, the family
I
together.
don't. Yeah, I don't mean with the Starbucks, the person you meet in the
Right.
Starbucks. I mean, they should be prepared to pay for some advice.
Right.
All right.
Especially right. And if the inheritance is substantial, it's worth
Well,
their weight in gold.
obviously, okay. To be able to plan around this. If I may make one additional point here that perhaps doesn't apply in the case of your particular person as a UK tax resident. One of the issues, okay, in considering renouncing U.S. citizenship is whether U.S. citizenship might have some value under a state and gift tax treaty. Now, this is not something that I'm an expert on, but I've seen enough of it so I know to be careful and consider this as an issue.
Yeah.
If you were to look at the U.S.-Ireland estate tax treaty, there are benefits in that are available only if somebody's a U.S. citizen. Okay?
Yeah. France is the same.
Yeah,
Absolutely.
Yeah, okay, sure. That doesn't surprise me particularly. So, that's another issue here, right? On, whether somebody should renounce because there are situations where U.S. citizenship can provide protection under an estate and gift tax treaty or an income tax treaty. I mean, we've talked about, that extraordinary provision in the U.S.-France income tax treaty where, France agrees to not tax, certain U.S. source investment income. I think 2 points here. First of all, Anthony, what I think is that the greatest wealth one can have in life is to be perfectly happy without any money. Okay, number one.
Yeah,
Money is
that's really your best defense, I think.
Yeah. Secondly, I don't even know why we're having this discussion. In the sense that I think that all we can achieve, and I hope we've achieved it, is I hope we've confused the person, actually, whoever asked the question, because the best service we can provide is to get that person in the hands of a competent advisor.
Yeah, she'll be listening to this. She won't be listening live, but she'll be listening to this.
Yeah,
so if you stress that, that's
so
good.
I want to emphasize also that not a single thing I have said has remotely legal advice or any kind of advice whatsoever. All right.
No, this is just general discussion. That's all.
Well, with that, you know what? And this is where I wanted to. So I just got this up here. I'll get this up here. So I just created a booking page for my firm here, book.parentandparent.com. And now what I want to do is I want to add, for people who want to talk to Keith or John, I want to add Keith and John to book at parentandparent.com. What do you say, gentlemen? You got game for that? So people can book right there. All right. I will we'll get you out there so people can have one place to go to get in contact, because sometimes you want to talk to Keith. Keith is not an attorney, so he could tell you things that as an attorney I can't tell you certain things, and John can't either. So Keith might be a great person to sort of get the of what you're looking to do, and then John.
Yeah, I just go over the different options.
And John is just so fantastic at so many things. Just one of the most brilliant lawyers around. We really appreciate his time sharing it with us. So with that, I think we've concluded today pretty well. Gentlemen, I mean, this is an absolutely amazing podcast. I mean, we covered a ton of material, and I hope we did confuse people to a degree. But I think the thing is like, look, the inflation has created. That means the tax storm is coming. That means you need to decide what you're going to do. Are you just going to sit there and be a target and be surprised year after year as you hand over more and more of your wealth and say bad luck? Or are you going to take action? If you're considering renouncing, you're going to talk to someone like John about the impacts about it. Or if you're going to consider staying, maybe you want to see if there's a way to get a tax plan together in order to avoid a lot of this nonsense and to protect yourself from, again, these high taxes that necessarily need to be coming in order to get rid of this high inflation that's been occurring. So that's kind of where we are. It's happening, it's out there, and it's time, I think, really to take action. So, one thing, be sure to subscribe to this channel because we'll be covering more and more of this is going on. And again, if you're looking, and by the way, if you're looking to be a guest on this podcast, you can also go to book.parentandparent.com. You'll see a link there. You can schedule a time and send me a little bit over, and maybe we'll get you on the show as well if you're interested in that. We're really trying to get the word out there about what's truly going on out there to protect you from all of this nonsense that's occurring, and hopefully to help you have some peace of mind. John, I want to get your concluding thoughts. You've been on fire today.
My concluding thought is find something that makes you happy that doesn't involve having any money. Okay. Take a walk, learn to read a book, have a conversation with somebody you like, and understand.
Learn a new language. Yeah.
Learn a new language.
There you go. Yeah.
Greatest form of wealth in life in this century is the ability to be happy with small amounts of money so that none of this matters to you. Seriously.
Right. John, I don't know. John, that was my thought this morning. That's really
a good thought, Anthony.
my thought. I'm like, you can't win the money game. You can't. They control it all. You have to take control of what you can take control of, and defining happiness through something other than whatever digits are in a bank account or aren't there. You're not going to get it. And I think that's absolutely right. So look for other things. There's so many wonderful things to be able to do in this world and learn about yourself. And that's really the best thing to do. So wise advice.
Maybe what we could do is set up a sort of a tax church, Anthony, and every Sunday people can come for a reading of the Internal Revenue Code.
Oh,
right. You can be the chief pastor.
I'll be right. And just the lesson is you can't win. Just understand, you can't
win.
Well,
the lesson is that it's not that you can't win. The lesson is that you need to stay completely below the radar of the Ron Wydens of the world.
Yeah. Okay. Yeah, exactly.
I mean, that Uncle Sam wants you.
Yeah.
You put together a new billboard. Ron Wyden.
Right. Wants your wealth. He needs it. He needs it for those hardworking people of Oregon, right? They're all demanding, hey, Ron Wyden, why aren't you going after people around the world, right? I'm sure he's got a lot of letters. I'm being sarcastic, of course.
That was a truly disgusting and despicable quote. One final thing about that quote is this, that, you know what, he might not like the Supreme Court of the United States, but it is the Supreme Court of the United States. And I think that there should be a respect for the fact that it is the Supreme Court of the United States. He may be a partisan jerk in his life, okay? But, I think it's unseemly and improper for him to start talking about Republican judges. This is just way over the top.
Yeah, I was like, well, are the Republican justices going to overrule the Republican law? Is that bad?
I don't think it's by no means clear to me that this thing is this Ninth Circuit decision is going to be overruled. I mean, it's clear to me there are certain judges who will never do it. And I think the issue is how it's presented. But I do not see this. I mean, we're seeing a lot of stuff from the Supreme Court that's much more nuanced. The addition of Justices Gorsuch and Jackson, arguably the far right and the far left united in so many areas. I mean, This is interesting, right?
Yeah, I want to make my prediction. I believe Justice Jackson will vote to overrule it. I believe she will strike it down. I believe that she will. She's been surprising me in many wonderful ways. I can't believe it.
She was, whether by accident or design.
And I'm not being sarcastic, by the way. No, I mean it. No,
I agree with you totally. I agree with you totally. But these are one thing about this generation of judges on the court is that by and large, if you look at it, and I did yesterday, it's a relatively young group of judges. Okay, relatively young. I think with an energy level, regardless of the decisions, I think the court has an energy level that really it hasn't had for a long time. And I expect
that's a good point.
That there's going to be a decent hearing out of this thing. That's what I think. I do not believe for a minute that judges like Kavanaugh and certainly Chief Justice Roberts, they're not reflexively going to be offended by this tax. And remember that Chief Justice Roberts in 2012 cast the deciding vote upholding the constitutionality of the Obamacare law on the basis, and I think this is a great thing to close on the basis that it was really a tax law. Right? That was the whole reason that the Obamacare thing was not struck down, because Justice Roberts decided that it was just a tax law.
If it's just a tax, anything's possible, right? Well, oh boy. All right. Well, that's a great way to
So
end
I
it.
would think that Ron Wyden ought to be, paying tribute to the Chief Justice every day.
Right.
You know,
Right.
right?
Why are you hammering on Republican justices? They're the ones who gave you everything you wanted. Right.
Right.
Wow. How
That's
ungrateful.
right. But
Ron Wyden, you can never make him
requires,
happy.
depth of insight. That can we really expect that from him? I don't know.
No. All right. Well, thanks everyone for watching, and we will see you next time. This has absolutely been a fascinating podcast. I thank everyone for joining so much. See you next time. This is Anthony Parent for Keith Redmond and John Richardson. Thanks for watching.